Main Street stock, ticker symbol MAIN. This stock is up 6% year to date and it has been an interesting ride so far. On the 22nd of February, Main Street presented their quarterly report where EPS was in line with expectations and a beat on revenue. People love Main Street stock because of multiple reasons, one of them being the dividend. And I understand why, with dividend yield at 6.2%, and of course with the monthly payouts. So could this be the perfect moment to buy Main Street stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Main Street do? Main Street Capital Corporation is an investment firm engaged in providing customized debt and equity financing to lower middle market companies and debt to middle market companies. The investment portfolio of the company is typically made to support management buyouts, recapitalizations, growth financings, refinancings and acquisitions of companies that operate in diverse industry sectors. Main Street reported a net investment income of $19 million or $1.07 per share. Distributable income was at $94.8 million or $1.12 per share. Dividends are declared at $0.72, so the dividends are covered very easily. This comforts me a lot. Return on equity was reported at almost 23%, looking really good as well. The net asset value is around $29, representing a 3% increase year over year. In here we see that year over year the numbers are also looking really good. We see total investment income increasing at 14% and net investment income at 19%. One of the main numbers for Main Street is the DNII. In here we see that it is increasing at a high rate. This means that Main Street is capable of growing the dividends alongside with the DNII at a high pace. On top of that, they also pay supplemental dividends, which is very nice. To me, it is very important that the portfolio is very diversified to minimize risks. In here we see that the biggest industry is only 8%. To me, this looks really good. The transaction type breakdown also looks pretty good to me, and it's the same with the geo breakdown. In here we see that total investment income is increasing quite a lot in the past couple of years, around 30%. And with that, the DNII increases also at a pretty high rate. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Main Street is a 3.89 billion market cap company. PE ratio is at 9, indicating they are undervalued. Later in this video I will show you my 3 price targets for Main Street stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 509 million, and in this graph we see that revenue went up in the long run. Of course we see the impact during COVID, and most recently revenue is really increasing at a high pace. Margins are going up and down in the past decade. During the lockdown periods, margins crashed. After that, they recovered pretty quickly, and most recently it is also increasing again. EPS is pretty much the same story as the revenue and the margins, nothing special to add here. Analysts expect that EPS will decrease from here in the coming 2 years, which feels a little bit random to me. I don't see a clear reason why this would happen, to be honest. For the revenue analysis, expect pretty much the same, and again I don't see any signs of this actually happening. Return on equity is reported at almost 23%, which is a great number. This is also one of the most important numbers for Main Street. Current ratio is at 0.98, which is a decent number. Right now, Main Street has 1.8 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Main Street has 60 million in total cash, so they can't pay down a big part of their debt. To me, this could be a potential red flag. So, it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is at a negative number most of the time. And to be honest, I don't like this at all. Most recently it is finally reported at a positive number. Shares outstanding are increasing in the long run, which is something that I don't like in general. But companies like Main Street issue new shares to raise capital, so I don't mind that much. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6.24%, which is a great number. Keep in mind that Main Street pays a monthly dividend instead of a quarterly dividend. Annual payout is at $2.88 and payout ratio is at 66%. I prefer 50% or lower. So right now they have 34% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 3.85%, which is a decent number. They have increased the dividends for 3 years in a row, which is very nice. And if you take a look at these numbers, the dividends paid since 2012, you see that Main Street did increase the dividends at a decent rate. However, during the lockdown periods they cut the dividend, which was a smart move but ended the growth streak. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio used to be a bit high, but it is coming down, which is a good thing. In this graph we see the expected dividends in 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at the same rate as the past couple of years. And overall these dividends look really good to me, but how about the historical returns? I decided to compare Main Street stock with the overall market, in this case the S&P 500. On the 5-year chart we see that Main Street was beaten by the S&P 500 by quite a difference. In total Main Street returned 78%, and keep in mind this is including dividends. The S&P 500 is sitting at 101%. On the 1-year chart things look pretty interesting. Main Street returned almost 33%, while the S&P 500 is at 36%, so they're really close. On the 6-month chart it is Main Street that is the winner, with almost 19% return, versus 16.6% return for the S&P 500. On the 1-month chart it is again a tight one, but this time the S&P 500 wins with 4.4% return. So bottom line, Main Street is really getting some momentum lately, but on the 5-year chart the S&P 500 was still the winner. So could this be the perfect time to buy Main Street stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 82, 84 and 86%. For the free cash flow margin I'm putting in 52, 54 and 58%. As I expected this number to recover in the future. For the PE ratio I'm putting in 10, and for the price of free cash flow I'm putting in 13, 14 and 15. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety with this company. Right now Main Street stock is at $46. I hit analyze and we see some interesting price targets. We have a low price target of $36 to $52, we have a mid-price target of $46 to $60, and we have a high price target of $59 to $70. So these are all big ranges. And to me, the low to mid price target is the most justified here. So that means they are right in the middle of this range. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Main Street is that I love the business. To me, it is a high risk, high reward investment in a way. I really love the monthly dividends they pay, and most fundamentals look good to me as well. There are some concerns about the debt and free cash flow, hence why the free cash flow price target is this low. On the other hand, the company is capable of growing at high numbers, and again, most fundamentals still look good. The valuation part is a bit tricky to me. When you have a big range like this, it is always hard to exactly pinpoint the price target. Right now they are in the middle of the mid-price target, so depending on how you look, you might say they are undervalued. In my opinion, they are fair valued, and I would love to see lower prices. I don't think we will see low $30 anytime soon, but mid 30 to high 30 would be great. And I will slowly keep adding shares of Main Street throughout the year, and in the meantime collect the dividends and analyze them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor, and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up, and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching, and I will see you in my next video.